Thank you, Mariam, for this introduction. So I've been sharing my slides. So I'm very happy to be here to introduce Eric's paper and comment on it afterwards. So let me say a few things, to give you the big picture on wealth and its distribution. So wealth is the sum of all marketable assets minus debt owned by households. So housing, pension funds, fixed claim, assets that pay interest, corporate equity, and other businesses. Now, if you look at the aggregate picture, total household wealth today is about 100 trillion. That's 5 GDP years, and that's up from 2.5 GDP years in the 70s. So which means that the weight of wealth in the economy or relative to the size of the economy has grown a lot, and that makes wealth, more important, and therefore knowing its distribution is particularly important. Wealth for economists, and in reality, we know that it provides safety for the bottom 90%, the ability, to smooth consumption and absorb shocks, and obviously provides power at the top. Power, to run large businesses that have a big influence on society, power possibly to influence the political process or get elected. Now, wealth is always much more concentrated than income everywhere and over time, because the bottom 50% in pretty much any society almost has no wealth. Estimating wealth and its distribution is important, but is difficult because we don't have systematic administrative data on wealth. We have an income tax, but we don't have a wealth tax that would give us systematically those statistics. So there are 4 imperfect sources and methods that have been used. So the first one, most visible in the press, the Forbes 400 rich list, and that one shows a sharp increase in the share of wealth going to that very select group. They owned about 1% of total wealth in the early 80s. Now it's almost 3.5%. Estate tax data measures wealth at death. Let me skip that one because we won't be talking about that one now. The 2 we will be talking most in this talk, in Eric's talk, is the Survey of Consumer Finances, which is a triennial survey since '89, which interestingly has been recently combined with financial accounts that give you aggregate wealth to create quarterly distributional financial accounts, and the capitalized income, which infers wealth from capital income reported on tax returns. So let me just show you, so Saez and Zuckman, we did capitalized income over a century, and that graph shows you the share of income going to the top 1% that has that big U-shape pattern, with in particular, what we estimated to be almost a doubling from 20% to close to 40% of wealth going to the top 1%, and the distributional financial accounts of the Fed that has the closest comparison because they use the same denominator, show a similar, although a little bit less of an increase over that period. So now let me say a few words about the Saez-Zuckman capitalization method, because Eric's paper is about refining, that method. It combines financial accounts that give you the aggregates with micro income tax data. It divides wealth by asset class, interest-bearing assets, corporate equity, business assets, pensions, etc. And for each asset class, computes an aggregate return. So for the interest-bearing assets, the return would be total taxable interest divided by total interest-bearing assets, that pay taxable income. And then you use the micro tax data and you infer wealth by multiplying each capital income component by the corresponding 1/r ratio. And so what we did in our paper with Zuckman is that we used a uniform return by asset class that we tested, using various data sources that links income and wealth, the survey of consumer finance, estate and income linked data, private foundation data. And that's where Smith, Zidar and Zwick start and further improve the method. So let me hand it on to Eric for his presentation. Thank you.
Thanks, Eric. Please go ahead.
Okay. You can see the slides and hopefully hear me. Okay, so thanks very much for organizing this. This is going to be a fun conversation today. This is joint with Matt Smith at US Treasury and Owen at Princeton. It's a work in progress. We're working on a revision, so I might touch on a few things that we're hoping to change, but we're just getting started there, and the pandemic has disrupted a little bit our work with administrative data, so I have maybe less progress to show than I might like. Okay, so Emmanuel did a good job of summarizing the problems with wealth estimation. There's not an administrative source available of wealth data, so you have to rely on various methods. And this graph sort of shows kind of the state of knowledge, at least when we started working on this project, comparing different methods. So the estate tax multiplier method showed high concentration in the early 20th century. That's the blue diamonds. Falling mid-century and then not rising that much subsequently. The SCF, which is this high quality survey, focused on those at the top, run by the Federal Reserve, shows a higher wealth concentration, a bit of sort of a more significant increase than the estate tax data. The SCF doesn't include the Forbes 400 for reasons of disclosure. So to get a comprehensive look at wealth inequality, you'd want to incorporate the Forbes 400. And so the hollow green triangles are doing that. You see kind of it's a level shift more than it is an increase in trend, although there's a bit of a trend coming from that too. And then you see the capitalization approach. Here we've put the tax unit-based approach of Saez and Zuckman, which is treating basically the tax unit as the unit of observation. Then there's in the Piketty, Saez and Zuckman paper, distribution of national accounts. They also have a wealth estimate that splits tax units into individuals, and we're actually going to be taking that approach, an individual level wealth estimate. Both capitalization series show similar high levels of wealth concentration in the early part of the 20th century that fell mid-century and then rose quite dramatically in recent years. So this is the top 0.1% share, just to be clear. Emmanuel was plotting the top 1% share. I think the reason is because the distributional financial accounts, they haven't released a top 0.1% method. But for the top 0.1%, you want to be thinking about folks in 2016 with about $14 million per person. Okay, so we're going to be asking the same question: what is the level and composition of top wealth in the US? So that series showed significant disagreement, or at least in recent years, about the level and trends in wealth concentration. It also didn't show, but that there is significant disagreement within these series about kind of the source of top wealth, of the composition, which asset categories are most important. Our approach is going to be a build on Saez and Zuckman's capitalization series, while accounting for return heterogeneity and mismeasurement with new data. Now, why might return heterogeneity matter? If returns are correlated with wealth rank and we neglect that correlation or don't take it into account, this could induce bias systematically in our wealth estimation. Second, there were reasons to believe that maybe the financial accounts, because of limited data, didn't have sort of the final answer about what the value of private business was. And so there was some room for improvement there, specifically using the microdata, which we'd collected for previous work, to try and estimate private business wealth, taking into account the heterogeneity within that population, and try and make some progress there as well. So with that data, we're going to be sort of linking people at the individual firm and owner level to the sources of private business income. And that's a useful contribution, we think, to try and shed more light on the nature of private business for top wealth. The paper has two parts. The first part is to document measure bias for all 5 major asset classes. which Emmanuel mentioned. Then we're going to provide new wealth estimates and explore implications for inequality and taxation. Our key findings in 3 buckets are summarized here. First, in our preferred series, wealth concentration is lower and has risen less than the equal returns approach would imply. So our top 0.1% wealth share is about 14%, or a little over 14%, compared to around 20% under equal returns. We have less disagreement in the early part, 1980s, so that the increase is significantly more modest. It's still significant, but we find that the increase in top wealth shares falls by almost half. We are not saying that wealth concentration is low. This paper is not an apology for rich people. The top 1% share is nearly as high as the bottom 90%. I think policymakers have a lot of reason to be interested in this group. I think we're interested in getting the facts right, both to inform policy, but also to inform kind of a quite amazing amount of scholarship and research that is built on these wealth estimates to try and understand kind of the nature of capital accumulation in the US and in other countries. And so we hope this is a contribution for that reason. We think I have more interesting things to say also on the composition of top wealth. So we find a quite large role for private business. So more than a third of top 0.1% wealth is private business in our series, compared to less than 20% under equal returns. Then we trace through the implications of our estimates for the wealth tax base and also the top capital share and top distributional national income. We're going to find the top 1% capital share in 2016 and distributional national income falls by 15 percentage points relative to the equal returns approach. So it's increased a bit, but a lot of the growth in the top 1% share is actually coming from sort of labor, human capital, as opposed to capital income. That's maybe a different story about the rise of top incomes than you might infer from the equal returns approach. This is also going to affect top tax progressivity a bit. Talk a bit about that, but not too much today. Bottom line is that accounting for heterogeneity and mismeasurement is going to matter for things we care about, like understanding the drivers of wealth and income inequality, and also for policy, thinking about the design and enforcement of capital income, estate, and wealth taxes. Okay, so the method, Emmanuel explained it quite well. It's a simple model using observed income to estimate wealth. Y is equal to RW. This is sort of the perpetuity version for a simple bond with no growth, the Gordon growth formula, but made even more simple. This cap factor is 1 over R. So we need a rate of return or capitalization factor. If you just want to treat this as an empirical model of wealth, where we're just looking for a coefficient on Y to estimate wealth. So the equal returns approach, which Emmanuel described, estimates R using an aggregate return that's the same component by component for everybody. For income, we're going to be using these de-identified treasury tax files. These are the same files that Emmanuel's been working with for the last 20 years on income inequality. So you have the capital components in broad buckets from those data. And then for wealth, we have component by component wealth from the financial accounts. We're going to be following the definitions that Emmanuel used in his papers quite closely. Total assets minus liabilities of households at market value, excluding durable goods and nonprofit wealth. We will depart from them because we're going to provide this external pass-through business estimate. We'll also include recent unfunded defined benefit pension estimates that have been supplemented onto the SCF by John Sabelhaus and Alice Enriquez-Volz, and they graciously shared that data with us. This aggregate is going to be different from the Survey of Consumer Finance's aggregate, just to keep that in mind. Now I'll walk through an example using taxable fixed income assets, where Y is taxable interest income, and W is non-tax exempt interest-bearing assets for the household sector. This is a useful thing to focus on because it's going to be one of the largest source of disagreement among the 5 asset classes between us and the equal return size Zuckman estimates. So here's a plot of the aggregates relative to national income for the 5 components. In the interest of time, I'm just going to focus on the blue circles. That's the fixed income assets, which you see is about 80% of national income in the in the 1960s, the beginning of our sample. Rises a bit, falls a bit, is about 90% or a little over 90% in 2016. here's the income piece. So this is fiscal capital income. So taxable interest is in blue circles again. We see that rises from about 2% of national income during the Volcker tightening in the early 1980s, up to 6% of national income. And then it falls during kind of the Great Moderation and the disinflation period. In 2016, it's actually at its lowest level relative to national income of the entire time series. So this is, you could take the ratio of this graph to the previous graph. That's the aggregate rate of return used in the equal returns approach. Now to generalize the model to allow different groups, we have a top group, that's T, a bottom group, that's B. We focus on fixed income assets. Blue items are things we observe. So we observe income for a group once we define that group. We observe aggregate wealth in the financial accounts. What we don't observe are the component by component returns, individual wealth for those groups. And we don't observe what they earn. Okay, so this is 3 equations and 4 unknowns. So we either need another assumption or some new data to be able to solve the system and estimate wealth for the different groups. And I'll talk very specifically about what we mean by top and bottom groups, because I think that's sort of an area of confusion, and we're trying to be very careful there because the ranks are important. Okay, so here I'm comparing alternative approaches. On the left, I have the equal returns approach. On the right, the heterogeneous returns approach that we take. We're going to divide the fixed income flow distribution. So we're going to rank people by fixed income flows into the bottom 99%, the next 0.9%, and the top 0.1%. So that's this over here. Under the equal returns approach, they all get the same yield, which is this R bar, equal to aggregate income over aggregate wealth. I'm going to capitalize their income accordingly to estimate their wealth down here. Okay, on the right, we're going to use other data sources to try and come up with good capital market proxies for the rates of return for these different groups. What we're going to end up saying makes a lot of sense to do is this AAA corporate bond yield. So the highest rated corporate bond yield there for the folks with above the top 0.1%. Then for the next 0.9, we're going to use the US Treasury 10-year yield. And then for the bottom, we're basically going to use the residual income and the residual wealth to estimate a rate of return such that everything adds up to total wealth. It's also going to provide a bit of an over-identifying assumption that we can test. They're going to capitalize income flows for these different 3 groups accordingly. Okay?
So can I ask a quick clarifying question, because this is really, really important. So here, by income, you mean interest income. That is, you separate into the high interest income people, you know, and the others. So say, if, you know, you should explain, you know, why you choose, you know, to rank by interest income.
Yeah, so, I mean, there are a few answers to that question. This is not our final ranking, just to be clear. This is just for implementing the empirical model for estimating fixed income wealth specifically. And so the question is, well, what do you observe? You don't actually observe wealth for people. We just have their income tax flows. So we have income. We can, you know, estimate basically for different, it's sort of a spline. We try and look at kind of in data where we have both income and wealth, where there seems to be heterogeneity that's materially relevant. It turns out that the distribution of interest income has a lot of concentration, and I'll show that in a couple slides, such that if you're slightly off for this top group, this top 0.1%, it generates massive bias in predicted wealth, and that shows up in data sets where you have both wealth and income. And so I'll show what that means in a second, but you know, we're open to other approaches for trying to guess wealth. The limitation we have is we don't know wealth, so we can't say, oh, we know the average rate of return for the wealthy is 2.5%, which is, I think, what you and Gabriel have argued for. But of course, we don't know how to rank people that way. We could estimate their wealth for all other components, and we might try and do that and see how, show how that looks in comparison. We might do that in our revision. But this is why we took this approach, because it was something that was implementable in data where you only observed income. And basically to take into account the fact that in the low interest rate environment, being slightly off for someone that has a lot of interest income flows generates massive bias that's quite relevant on a dollar weighted basis. So I'll show that also. I think it's a great question. I think it really does get to kind of the heart of where we haven't fully reconciled yet.
One question from the chat related to that. What kind of wealthy individual has most of their money in bonds, paying basically nothing or negative in real returns?
Yeah, so I think the answer is not, that's more of a question maybe for you and Gabriel, because I think we're trying to make the case that folks who have a lot of interest income are not holding very safe bonds. Their taxable interest income is generated by investment grade corporate bonds or more boutique mezzanine investments that generate higher rates of return, or even GSE bonds that haven't been issued recently but have been issued in the recent past that are paying interest rates of 4 or 5%. And that's all you need to generate a rate of return that corresponds to this AAA yield. But I think we'll probably come back to this. But I think, Valentine, that's exactly the right question to be asking. So on the equal returns approach, the aggregate yield that you compute for 2016, you take $102 billion of fixed income flows, divide by 12.6 trillion in wealth, 81 basis points. That's a cap factor implied of 124. So for every dollar fixed income flows under equal returns, you estimate that corresponds to $124 of wealth. For this top 0.1% of fixed income flows, they have actually about half of fixed income flows. It's an exceptionally concentrated category, much more concentrated, I think. My prior is that it's more concentrated than overall fixed income holdings, but that's something we could talk about. But what you get is $6 trillion of wealth for that group. If instead you use the 3.66% AAA rate, that gives a cap factor of 24, and that group has 1.2 trillion. So that's a $5 trillion difference, which is, roughly 5% or a bit more of national wealth. So it's a big difference across the two methods. And, we end up having 9.8 trillion for the bottom 99%. Their interest rate is about 23 basis points, which we think of as reflecting the fact that most of their interest is coming from deposits. And I'll show some data on that as well. Just to give it a little bit more intuition on what equal returns is doing, because we're applying the same transformation to income for everybody, the fixed income wealth rank is the same as the interest income rank. So it's basically taking the income share of total income for that group and proportionally allocating fixed income wealth. So we can look at what's happened with those shares over time. So here's just the interest income share for different groups. In 1965, the top 1% of interest income, taxable interest income, was under 40%. It's now almost 80%. And you can see it rapidly rises in the low interest rate period in the mid to late 2000s. And our interpretation of this is probably that there's a lot of interest income that's showing up outside of taxable interest income, such that what we do observe is maybe not as representative of the total population or distribution of fixed income wealth. And that's something that we can dig more into. But why is that? So if you look at the information return for interest income, this is what's supposed to be what's supposed to be reported. It includes both interest on bank deposits, which, as we know, in recent years have come down quite dramatically, close to zero, and also lots of other forms of indebtedness. So all types of corporate bonds, debentures, notes, loans, even to closely held businesses, all that kind of interest would show up there as well. So it's a broad bucket. It's quite plausible that there's portfolio heterogeneity that reflects sort of risk differences and just basic maturity differences across assets. On the left, we have fixed income portfolio flows. We rank people here by wealth group in the SCF because we observe wealth in the SCF there. The bottom 90% has 80% of their fixed income wealth in liquid assets and deposits, so very low interest earning assets. The top 0.1% and top 1% have the majority of their fixed income wealth in mutual funds or other funds. excluding money market, bonds, both corporate and government, and much less in liquid assets deposits. And we think that's a first order driver of heterogeneity in rates of return. And then accounting for that, especially in the low interest rate period, is quite important for removing capitalization bias. So on the right, we have kind of the basis, the data that provides the basis for our use of the AAA yield over time for the top group. So we sort people in the SCF and also in estate tax data, where we've matched that to income tax data following the work that Gabriel and Emmanuel have done. And then we estimate the interest rates for these different groups, and we see that the top 0.1% has a much higher rate of return, and it is actually a bit below the AAA yield on average across these years. That's also true in 2016 and the recent low interest rate period. The next group has something that's like the 10-year yield. Maybe it's a bit higher. Maybe the 10-year yield is a bit higher than in the estate tax, but it's about the same for the SCF. Deposit yield looks like a decent fit for the next 9, and then close to 0 for the bottom 90. And here I actually put the interest income thresholds just so folks can understand what we're talking about. The top 1% threshold is just $4,400 of taxable interest in 2016, so not very much. The next 0.1% threshold is $39,000. So there are people with 6 figures of interest income. And the question is, should we take the same interest rate and capitalization model for those people that we do for people who have a few $1,000s of interest income? We think that that's probably not a good thing to do. And especially in the low interest rate period is going to generate quite dramatic bias in estimating this component of wealth. So let me just show what that means. So over time, when we plot the interest rates here on the left, we have a bunch of different interest rates, but the equal returns rate is this red series. The AAA yield is the blue series. You can see a consistent spread, also the trend down. The deposit yield we have here from Savov and co-authors. Then we take the reciprocal on the right. You can see that in the low interest rate period, the equal returns approach, as that rate gets close to 0, that capitalization factor really kind of blows up. Even the treasury yield doesn't sort of take off nearly as much, although probably in the quantitative easing period, it diverges from AAA more than it did historically. The AAA yield, we can see kind of what that capitalization factor looks like. It's increasing a bit since the 80s, but not dramatically. And so you can see kind of, it's not just for the level of fixed income wealth estimate, but also for the trend that changing the rate makes a big difference. And so if we just take these different models and see how much wealth we're talking about, I kind of walk through this in the whiteboard version. On the left, we show that it's not really about the ranks that we use for who's in the top 0.1%, but it's really about the model that drives the difference between equal returns and our preferred estimate for fixed income wealth. Now on the right, you can see a lot of the difference between the equal returns and our approach in terms of the top wealth share of what's happened in recent years is coming from this correction. If we were to use the treasury yield, it would go closer, but it would still be quite different from the equal returns approach. Just as a reminder, AAA rating for corporate issuers is not something that many corporate issuers have the benefit of receiving. It's really just Microsoft and Johnson & Johnson in 2016 that have the AAA rate. So all investment grade issuers in the corporate sector, which is a lot of fixed income assets, actually have higher yields. And that's not including sort of junk bonds, mezzanine stuff in private equity deals, foreign sovereign wealth, and GSE securities from historical issuance. So we think there are a lot of assets out there with higher rates of return. And so we don't think AAA is a super aggressive thing, but that's just providing more background.
Eric, let me ask you something here. So the AAA Moody is for long-term corporate bonds, with 20+ years maturity. Do you know what fraction of corporate bonds are these long maturity bonds as opposed to shorter maturities?
So I think we're gonna maybe provide some more data on this. I don't have the shares. I would say that most of these AAA issuances, so most corporate bond issuance, my understanding, and I'm not a bond expert, but I think we have a lot of experts on the call actually who can weigh in on chat. Most of those issuances would be in the 5 to 10 year range probably for corporate bonds, maybe a bit some shorter. I think if you look at, where a lot of the corporate bond issuance is in terms of outstanding, a lot of it's in the investment grade bucket, but below AAA. So it's going to have higher yields, I think. And I don't think this AAA rate is, maybe you can look at any other corporate
Yeah.
rate. On Fred, I think you have higher yields also.
Yes, but those are long-term bonds in the sense that if you took, the Treasury 30-year, you would also find, a rate substantially higher than the 10-year.
Right. I mean, most corporate issuers are not issuing at that long a horizon. So I would say it's a pretty small share of issuance by corporates is at that long a horizon. So I'm not sure what kind of Bloomberg printout you're looking at. But I'm happy to take suggestions from folks in chat who are kind of bond experts on this. Maybe we can keep going. I'm actually going to skip this slide, but Emmanuel, we can talk about it maybe during the Q&A or later. This slide is just showing that it makes a big difference whether you rank folks by wealth or by interest income when you're estimating returns. That's not to say that we don't think that taking the interest rate for, say, the top wealth in our series is a good moment to try and match. We're going to add that going forward to think about the interest rate.
Yeah, but this one is particularly important, so that the audience understands. That is, if you rank people by interest income and you take the highest interest income earners, they do appear to have a high return, because you get a high interest income because you have IR or R big W.
Yeah.
If you take the wealthy, as you're doing, on this left panel, the rate of return doesn't look nearly as high as the high interest income earners.
No, that's right. And I think, of course, the reason for that is because the highest wealth people have very little fixed income wealth. I mean, it's sort of like their portfolio shares in fixed income are quite low. And so, to the extent they allocate fixed income wealth, it's not surprising that it's in relatively low risk stuff because most of their portfolio is in much riskier stuff. So I think it is a good moment to use as kind of a test of the model. But the question is, if someone has $1 million of interest income flows, how much wealth does that correspond to? Does it correspond to, $100 million, $50 million, or $25 million? And I think that's not the same question as the interest rate for the top wealthy. But no, I agree it's important because that is kind of getting to sort of the nature of our current disagreement. Okay, so I'm sure there's lots of good questions on this subject that we can keep talking about. Let me briefly talk about public equities, which is the other component where I think Emmanuel and Gabriel have taken some issue with what we're doing. So for public equities, there are two flows that can be used. One is dividends, the other is realized capital gains. Both might be useful because, of course, they're non-dividend paying stocks. And a lot of folks, generate kind of their yield from, say, retained earnings and buybacks and maybe selling stock occasionally. The issue with reusing realized capital gains is that, again, it's a broad category. It includes a lot of not obviously C corporation stock sales that might be used to infer wealth. So it includes real estate, private business. Importantly, it includes a lot of carried interest compensation, which is really the share of profits for venture capital and private equity managers. It's kind of a one-time payout. It's quite different from reflecting underlying going forward wealth. And of course, we know the capital gains realizations are quite lumpy and not very persistent. So conceptually, these are not a great predictor for wealth that turns out to be true in the data as well. But what we're going to do is we're going to try and use the SCF where we have both stock wealth and these flows that we observe. We're going to try and construct a composite flow measure that combines dividends and capital gains in a similar spirit to what Saez and Zuckman do. This alpha is going to be the weight on dividends. In Saez and Zuckman, there's equal weight, so alpha of 0.5. We're going to ask the SCF what weight we should use, pooling over all the years. The answer is something closer to 0.9, so 10% weight on capital gains, 90% weight on dividends. This is not the same thing as doing 0% weight on capital gains. We are not just using dividends, especially because realized capital gains is an aggregate. It's about 2 to 3 times larger than dividend flows. there's significant weight going on realized capital gains, and the SCF data suggests that if you don't do that, you do miss significant wealth. Just to give a sense of the range that you could possibly get, matters going from equal weight unrealized gains to dividends only, matters for about $1.5 trillion to $2 trillion of wealth in 2016, about 2 percentage point spread. So, it's doing some of the work in explaining the difference between our approach and the equal returns approach, but more of it's coming from fixed income. Another thing that shows up here is you can see when you include realized gains, as we do, the stock market boom and bust shows up, whereas it doesn't show up nearly as strongly in with the dividends only series. You also see that the increase from 1980 is coming from stock wealth. I think that's informative and is telling us sort of where the growth in top wealth inequality is coming from, at least part of it. Okay. The other three components, I don't have time to talk through, but I think our pass-through business thing is quite neat and was fun to do. Unlike the first two adjustments, it actually increases concentration modestly. We're going to be accounting for industry and firm level heterogeneity using public company valuation, so a multiples-based approach from public company valuation to the industry level instead of the financial accounts aggregates. We're going to make a liquidity adjustment using SDC data on mergers and acquisitions, private firm sales. We're also going to be using our previous paper to adjust profits of pass-through businesses for labor disguised as capital or recharacterized as profits. Overall, we're going to be allocating wealth away from high-skilled services like doctors and lawyers towards real estate owners, and that's why wealth concentration increases. This is going to push a bunch of pass-through business owners up into that top 0.1% and push out some of the fixed income folks, which is why also our top 0.1% doesn't have an interest rate exactly equal to AAA, but somewhat below. There's going to be folks like from this group that end up in our top group. For housing, we're going to allow for heterogeneous valuations across US states, the flow being capitalized as property tax deductions, and we know the property tax rates vary across states. This adjustment also modestly increases concentration because it moves wealth from Illinois and New York, where property taxes are quite high, to California, where property taxes are a bit lower. And finally, for pensions, we're going to have an age profile for pension wealth that matches the life cycle profile for pensions that we see in the SCF. We'll exclude rollovers from estimating pension wealth, which tends to move pension wealth up towards the top. And we'll include an estimate of unfunded pension wealth from Sablehouse and Volz. We've also taken data from Catherine Sarin and Miller's paper on Social Security and constructed an auxiliary series, which we report, but our preferred series doesn't include that. But I think conceptually talking about Social Security is a really fun thing to talk about, but it's probably going to drive us down a rabbit hole, so maybe we won't talk about it too much today. Okay, in the interest of time, let me show some results. Here's our series that adds up all 5 of our adjustments. So in dark blue, you can see roughly agreeing with the equal return series in the early part of the sample, but diverging, especially in the low interest rate period, showing a modest but substantial increase that lines up quite well with the SCF plus Forbes series, although not in 2016. I should note that the SCF series is a household unit level series. And so there's some corrections that need to be made to actually bring it back in line to the concept that we're measuring in our individual level preferred estimate, and actually can account for some of the difference between our estimates and the SCF in 2016. So it's important to keep in mind that the unit of observation isn't necessarily the same across all of these, and that's sort of one area where we need to be more careful and others need to be more careful. I think Emmanuel is very careful on this in general, but making these comparisons, it's important for folks who are sort of outsiders observing to ask the question, what is the unit of observation? Are we comparing apples to apples? For where does the wealth go if it's coming out of the top group? Here we show under equal returns, the top 1%, the next 9%, and the 0 to 90. You can see under equal returns, the top 1% has the secular increase and ends up with more wealth in 2016 than either group. In our preferred series, we still see an increase for the top 1%, although it's a bit flatter. And in our preferred series, the 90 to 99 group ends up with the most wealth, or roughly about the same as the next 90%. So there's still a lot of wealth concentration here, but it's sort of a different composition. This is a table with thresholds and average wealth numbers for our different groups. I'm only going to highlight a few things here. The main thing is that our adjustment matters more and more the further up the wealth distribution goes. So for the top 1%, preferred versus equal returns average wealth is maybe different by about 10%. For the top 0.1%, average wealth is different by more like 25%. And for the top 0.01%, average wealth is different by about a third. And that's because, we think this bias, because it's sort of a dollar-weighted issue, is more important the further up in the tail you go. And so changing the model to not amplify folks at the very top right of this interest income distribution, for example, matters a lot for this top wealth group. Okay, this is going to matter for things like the wealth tax base, which is very progressive. So draws a lot on wealth above a very high threshold. In terms of asset composition, under equal returns, the top 0.1% portfolio share for fixed income is around 40%. Is actually increasing quite dramatically in the last 10 or 15 years as interest rates come down, which we think is probably telling us that there's something of an issue with that model. Private business is only 15%. Our preferred estimate has fixed income share of around 18, 19%, which looks more like what the SCF and the estate tax data look in terms of the portfolio shares. We have a significant share of equity, although we are seeing more public equity than the SCF and the estate tax. One thing that I think is a continuing work in progress is trying to take apart some of these equity categories and pass through business. The way the data shows up on income tax returns might be easier to sort of separate C corporation wealth from non-C corporation wealth than it is in something like the SCF or the estate tax as it's reported. But the main thing to take away is a much larger role for equity, especially private business, and a smaller role for fixed income wealth. On the left, so these are the same data, but now just the aggregates. On the left, we have the top 1%, and I'll just highlight this gray bar, which is the DFA series. So our estimates are below the DFA fixed income shares for 2016, closer for 2013, I think. Right on for public equity, and very similar for private business. You can see the SCF has much larger private business. I think some of this might be due to categorization across categories. Some of this might be due to valuations that folks state in surveys. And so we're trying to think about different ways to benchmark and explore that. Overall, we view this as sort of helpful and kind of pointing towards areas of ongoing or future research to try and dig into differences. We can see a large work of the difference between ours and the equal returns coming from fixed income, secondarily from public equity, and we're moving more into private business. I should note that we have some data where we try and split C corporation wealth into private business, which is just sort of new data that we were able to contribute. This is not something that was a focus of Emmanuel and Gabriel's paper, but we think it's important, especially if we're thinking about wealth tax compliance. So our private business estimate does include that, whereas when I'm talking about the equal returns approach, we're not including it. So a big chunk of the adjustment is coming from that shift. Okay, so it's worth mentioning that. One of the nice features of our data, we're able to break out the wealth distribution across states, and we think a more accurate way, and look at, say, evolutions in things like the wealth to income ratio over time. It is election season, so we have an adequately, properly colored map, I guess, although it might have more red states than folks on the call prefer, but no comment there. But what we see is a striking divergence in wealth to income ratios across space. Coastal states have much more growth in wealth to income than states in the middle. And this spread is actually of the same order of magnitude as the spread across OECD countries in Piketty and Zuckman's Capital's back paper. So something pretty interesting to dig into, how much of it is economic divergence versus migration across states. So just a little bit on the Forbes. This is a work in progress, trying to think about the best way to deal with issues with the Forbes. Public equity wealth for people like Jeff Bezos, Mark Zuckerberg, it's pretty hard to estimate with their tax data because they own public firms. Most of their wealth is in those public firms, and those firms don't pay dividends. So both our approach and the equal returns approach is going to fail to estimate this group's wealth. I should note that it's not the case that all super rich people on the Forbes list own firms that don't pay dividends. So Bill Gates, the Waltons, others that own, say, maybe older companies do have dividend-paying public firms, and those firms pay a lot of dividends. And so we might actually not be that far out for that group. But we're thinking about ways to try and benchmark our estimates and say plug in the Forbes 400, and we have to think about who we remove if we plug them in. And we have issues with disclosure and identifying people that makes it difficult to just sort of identify these people specifically, which we're not able to do. But one additional thing I'll say is that, Pareto extrapolation of Forbes aggregates, and this is something that I'm curious to hear Emmanuel's perspective on. If you take the Pareto model, yeah.
Can I ask you a question, on the previous slides? Because, the wealth tax as they were proposed, had higher rates on billionaires.
Yes.
And your billionaire wealth is lower than what the Forbes has. So which estimate do you trust better, yours or Forbes for billionaires?
Yeah, so I think they're both informative, and I think for Bezos and Zuckerberg, I like Forbes's estimates much better than ours for the same reason I like I think just the capitalization method has limitations for estimating wealth of those specific people. So I think and I think we were in agreement on that. I think for billionaires that are further down below, it's sort of an open question, is Forbes doing a better job, or are we doing a better job? Because Forbes has limited information, it's journalism. They're very serious people trying to do the best they can, but they're using only public information. It's very hard to estimate. We went through, and roughly half of the wealth on the Forbes list is from people whose wealth is primarily from private business, not from public business. And so it's quite hard to estimate the value of those companies. So I think it's a bit of an open question. I think we should, the first order thing is that there's some standard errors here. I also think, we shouldn't overstate the importance of Forbes, because even if you take the Forbes 400 number right off the shelf, it's a few percent of total wealth, right? 3 or 4%, like you said on the previous slide. So it's not like missing them by being low 50% by them is driving the largest difference between our estimates for especially these groups like the top 0.1%. I think so. It's an area to keep working on for sure. But I think it's hard to just say, like, let's take Forbes, at face value, as opposed to trying to draw in as much data as we can. And I don't have a ton of time, but like when we do take the Forbes number and try and take a Pareto distribution and map it down to lower quantiles, those implied shares in green look kind of like our top 0.1% and top 1% shares. There are issues with using the Pareto approximation as you move further down the distribution, but we sort of think that simulations suggest that this isn't that problematic, but Emmanuel is the Pareto expert, so I won't spend too much time on this slide for fear of losing my head. The last few minutes I have here, let me talk about other things that are relevant for the wealth distribution. So here, I have a flow chart that summarizes a pretty, a super impressive body of work that draws on the tax return data to build wealth estimates. But then you take those wealth estimates and combine them with national income accounts data, you get the distributional national accounts from Equities, Saez, and Zuckman. What we're doing there is taking wealth to allocate income that we don't observe on tax returns that is in national income. And then the last step is if you have macro tax data, various incidence assumptions and allocation assumptions, you can get the tax rate progressivity estimates that Emmanuel and Gabriel published in their book and Brookings paper. So the wealth estimates are kind of, there's an implicit wealth distribution, and a lot of these cases is actually explicitly included and upstream of these other research questions that are of independent interest. So what we do is try and trace through our preferred refined wealth estimates and estimate the effect on, say, the wealth tax base, top income inequality and its composition, and also top tax rates. Wealth tax base is smaller in our estimates, although it's subject to the caveat that Emmanuel raised about the sort of the billionaire piece, for sure. And I think, in our revision, probably most of the wealth tax stuff that's in the current paper is going to come out by preference of several referees and editors and this kind of thing. But, we'll see how much we get to continue to include. But I think the burden on private business in a wealth tax and in any kind of capital tax is still there and quite present. So it's going to apply sort of more enforcement agents and more evaluation, sort of creative valuation methods than if it was just sort of liquid securities with easy values. For imputed national income, we're going to have a lower top share and a top share that is sort of more dependent on labor than capital. I'll show that. Equity income is more important than fixed income, and larger effects further in the tail. And it's going to increase top all-in tax rates by 3 to 5 percentage points. The reason for that is that the denominator in sort of at the very top of a tax rate, sort of your broad market income is going to be a bit lower under our estimates. Let me go a little bit more detail into the imputed national income. And this is sort of the last thing I have to show, a couple slides on this. So if you use wealth estimates to allocate non-fiscal income, with that fixed income example from the beginning, under equal returns, you get fixed income flows, which are much broader than what we see in taxable interest income, going up from 1.5% to 2.5% of national income. This is for the top 1% in income. Under our preferred series, it's a bit more flat and lower with the larger wedge in recent years. It sort of looks like the fiscal interest series. This is going to feed into with our other adjustments a capital income series that we see capital income for the top is rising in our preferred estimates, but maybe less dramatically than under equal returns. As a result, the share of top 1% growth under equal returns that comes from labor versus capital changes significantly. So under equal returns, the share of top 1% growth that's coming from capital is 5 of 9 points. For us, it's 2.4 of 8.1 points. Okay, and so I can show that in a different way. We have a very similar trend in top income shares. Top income inequality is going up, but it's, the importance of capital, it's true it's come up a bit since 2000, which was a local minimum, but it's maybe sort of flat if you go back to the 90s in terms of the contribution or the capital share. And just to conclude, hopefully on time, I was keeping time, but not sure. I think we're doing roughly about what we were supposed to. Key findings, we're going to find that wealth concentration is lower, it has risen less, but is definitely not low. Document a large role for private business. Our estimates are going to reduce the wealth tax base, the top capital share. But I think another bottom line sort of methodological is that these methods do entail uncertainty. We're hoping to try and, that these things should be made more salient. We're thinking about ways to do approximate inference here, so we don't just have preferred estimates, but also something like standard errors. Still working on that. But, it's going from a limited but very useful data resource, the income tax data, to an unknown, unobservable entity, the wealth distribution. And so, there's a set of assumptions that, we think the sensitivity should be demonstrated. And we're hoping that we're, helping to push this thing forward, that we're doing a positive sum contribution here, and not just, throwing tomatoes in mud and having some fun with it. For things that we care about, drivers of wealth and income inequality, a lot of open questions that we hope to dig into going forward. And for thinking about the design of capital income, estate, and wealth taxes, there are a lot of open questions as well. So thanks a lot for listening. Looking forward to the conversation going forward.
Thank you.
Okay, great, Eric. Sorry. So I'm going to pass on the mic to Emmanuel to give us his discussion.
Thank you. So let me pick up where I stopped. So Eric did a really good job at presenting the papers and pointing out the two key discrepancies that explain most of the top wealth share differences between what they have and what we have. One is the interest capitalization. They use the AAA Moody rate for long-term, long maturity corporate bonds at the top of the interest distribution. And second is the corporate equity capitalization, where they put more weight on dividends than and less on capital gains than we did. So let me start with interest rate capitalization. So in terms of theory, if the wealthy do have an interest rate RW, say on their fixed claim assets higher than the average rate of return economy-wide, definitely you should use that differential, higher rate to capitalize interest rate. And if you look at data, RW, that is the interest rate that the wealthy gets on their fixed claim assets, is quite possibly slightly higher than the rate of return aggregate since the Great Recession. But we claim that the super wealthy, as far as we can say, never get close to a rate of return to the AAA. And so let me show you this graph. So this is the AAA rate of return in 2016. This is the macro interest rate, roughly 1%. If you look at entities that hold a lot of fixed claim assets for which we have both interest and assets, what do we see? If you look at listed corporations that own fixed claim assets, their rate of return is 1%. S corporations that have a lot of assets, more than 100 million, it's also about 1%. Estates larger than 20 million, that is wealthy descendants, it is somewhat higher, 1.4%. And the Gates Foundation, the richest foundation that has literally billions in fixed claim assets, a lot of which is invested in government bonds, etc. They come nowhere close to a AAA rate of return. Apple is the biggest holder of fixed claim assets. They have something like 200 billion in fixed claim assets, lots of which is in corporate bonds, but short-term maturity corporate bonds, and that's why their rate of return never reaches, the long-term Moody rate. So when we see that evidence, we think that a reasonable estimate of what is the rate of return on the wealthy, and that actually matches the SCF. So careful here, it's the rate of return of interest-bearing assets on the wealthy is maybe 40% higher than the macro rate, and that's how we revise our estimates. We give a 40% premium on the wealthy. So what I call, here, what we think is a flaw in the analysis presented is that they use top interest earners that are going to have high interest rate, similar to the AAA, but this is really selection. That is, if you select people with high RW, you are going, almost by definition or measurement error, select on IR. And that phenomenon is true, Eric has talked about it in any data set. If you select the wealthy, you don't find such a high interest rate on their fixed claim assets. If you select the high interest income, you are going to find a high interest rate. And the interest rate of high interest earners, in our view, is not relevant for capitalization. The theory, as far as we've been able to work it out, formally, requires you to use the RW, the rate of return on the wealthy. The consequence of that is that it is true that in our old estimates, we had too much fixed claim assets for the top 1%. We had 9 trillion. Smith, Zidar, and Zwick think it's only half of that. In our updated estimate, we go down to 7, which we think, doing our best to compare with the distributional financial accounts that really use the exact same totals, matches the distributional financial accounts. Corporate equity capitalization, many top billionaires own companies paying no dividends, as Eric mentioned. So capitalizing using only dividends cannot capture their wealth. And even with capital gains, it is challenging. So the less you put weight on capital gains, the more challenging we think it is. And a very simple way to do that, to see that, is that how do you compare with the Forbes, at the level of billionaires? So here are the numbers. Forbes billionaires supplemented with the SCF in 2016 is 3 trillion. In Smith, Zidar, and Zwick, you get about 1.7. In the old estimates of Saez Zuckman, we actually matched the Forbes pretty well, but we probably got the composition wrong because we had too much fixed claim assets and too few corporate equities. And so when we revise, we've decided that in reality, it's too challenging. With the capitalization, you're not going to do a good job with billionaires, so it's better to just adjust corporate equities to match Forbes and SCF. So to really estimate the wealth of the wealthiest, Jeff Bezos, etc., you are going to do a much better job at just looking at public data, on ownership of large publicly listed corporations, knowing that, yes, you're not going to do a perfect job for the privates. Maybe there is room to supplement, but for the really, the lot of people, who've become public and are the deca-billionaires, Forbes is just the best we have. So the bottom line is that, you remember the white and our original series, the blue, the distributional financial accounts. When we are going to revise, we find a level, of top 1% wealth shares that's slightly lower because of these interest rate things. But then when you benchmark to the Forbes, you bump up a little bit, and in the end, we're not that far away from our initial series. I think, Smith et al. Are about here for the top 1%. So, through this ongoing debate, we've adjusted, we've learned more, but I think, we still have a discrepancy that I want to remind you, whether it's 35 or 30, that looks big, but remember, wealth is so heavy now, it's 5 times GDP, while here, it was only 2.5 times GDP. So in reality, the weight of wealth at the top has doubled, relative to what you are seeing here, relative to the size of the economy. So that's why, wealth is heavy at the top. We all agree on that. And yes, let's do more work, to try and fine tune the best estimates we can. Thank you very much.
Okay, thanks so much, Emmanuel. So Eric, do you want to take a few minutes to answer Emmanuel before we go to questions? And please, anybody, if the audience, if you have questions, please don't forget to raise your hands so that we can call on you. Eric?
Yeah, so awesome. And I won't talk for very long. Thank you so much, Emmanuel, for taking the time to participate and for weighing in. I think, like the big picture is that we hope that, by participating in this conversation, we're helping to move the debate in a good direction and move the literature forward. And I think the updates that you guys are doing are definitely moving in that right direction. So I think, and perhaps you would have been less willing to do those updates because there would have been less reason to. And so I think maybe, even if it's sort of awkward, we're all learning stuff, which is good. So using heterogeneous rates in wealth estimation seems like important, and maybe the next step would be to make sure that you're using them also in the national income estimates, because those would be relevant too there, I think, and also in the tax progressivity estimates, because they would be relevant there too as well. And so I think that's a question I have. And then a second thing is, I noticed in the discussion a switch to the focus on the top 1% as opposed to the top 0.1%. And I'm wondering if that's just because of data availability, and if the view is that there's still like less discrepancy when we move further into the tail, because our paper was more focused on kind of further up in the tail, people with $10–20 million. You know, the top 1%, the issue also with the DFA, you need to adjust for the household versus individual level thing. And so it might look like we're more inconsistent with the DFA than I think we actually are. We'll look at the billionaire wealth correction and think about incorporating it. You know, I think it will not have that much of an effect, but will have an effect, say, on wealth tax estimation, like you said. So that's relevant. And the last thing, the first graph you showed on the portfolio of Apple and the Gates Foundation, I mean, the thing that's missing from this graph that we really want, maybe folks on the call have it, we would actually like to see wealthy people's portfolios of fixed income assets and what their interest rates are and what their assets are. So the fixed income portfolio of Apple, the company, is not super informative in my view of like the portfolio choice problem that a rich person has, because Apple has a very concentrated ownership in Apple as a company. And so the way they allocate their fixed income portfolio might be not that informative about someone at the top of the wealth distribution who has more diversification. So I'm not sure how useful that data is. And as I said, there are a lot of assets that have interest rates above the AAA rate. And so we're happy to list those going forward, but maybe let's turn to the audience.
Okay, great. So let's move on to the questions, because there's quite a couple of questions. So let's start from Andy Atkinson from UCLA. So Andy, please go ahead.
Okay, thank you. I found this very interesting. I'm confused on this point about the importance of fixed income assets in the shares. I'm starting from the observation that although there are a lot of debt securities out there, the flow of funds lists on table L208 almost 50 trillion in outstanding debt securities, which would be about half of total household wealth. Only 5 trillion of that is held directly by households. The rest is with foreigners, with the Fed, or run through various financial intermediaries like life insurance companies and banks. So I think Neil asked this question in the chat. I'm confused about what is the size of the fixed income wealth that we're thinking about, that we're arguing over when we're trying to apportion it to different households?
Yeah, so I'll answer that first, but Emmanuel might actually have something to say as well. So there's the stuff that's held in, say, pensions, life insurance by foreigners is being allocated separately, or in the case of foreigners, not at all, because it's being allocated in proportion to, say, pension income, for in the case of pensions. The aggregate number in 2016 was like around 10 trillion, the number that we were talking about. So a significant subset of all fixed income assets that you're seeing in that L208.
But then how do you reconcile that with the flow of funds when they say only 5 trillion is held by households?
So Emmanuel might have the answer to that question.
Yeah, so you know, fixed assets, you know, are in many forms, and what the fight is about those that pay taxable interest. You know, many others, you know, don't pay taxable interest, so they are capitalized differently. And indeed, you know, so there was a question in the chat. As we were doing this revision, we realized that actually all mutual funds that have bonds, money market, don't actually pay taxable interest. They pay dividends for tax purposes. So we were wrong in the way we were capitalizing that. Zwick et al. Followed us, so you know they had the same mistake, and that's something we've just fixed. But basically the job, of what we are doing is that we take the flow of funds, we look at each component. If it pays taxable interest, it's capitalized with interest income. If it pays something else, tax exempt interest, it's capitalized with something else. If it's in pension, it's capitalized with something else, and so on. So, in principle, we hope we do the things right, but it's work in progress. But in principle, it reconciles, fully the aggregates with the micro data. Coming back to what Eric said, when we modify the wealth estimates, it flows into everything. It modifies the national income. It's all an integrated thing.
I do think one large category, and Andy, might be deposits that might not be in L208, but I'm not sure.
Yeah. Deposits also, a lot of deposits don't pay interest, and those are not capitalized. They are actually benchmarked on the SCF directly. That's how we do it.
Right, but there are a lot of deposits that do pay interest that pay taxable interest.
That would make it hard for them to get a Moody's AAA. That would argue in favor of a much lower interest rate.
Yeah, but that would be for, we think that those, a lot of those dollars are not being held by the folks at the very top of the interest income distribution, that their portfolios are mostly not in those assets, which I think is sort of what the SCF would show.
Okay, great. So just for the audience to all are aware of, as Valentin posted on the chat, we're going to take 5 minutes more to be able to go through not all the questions, but a couple of questions. So the next question would be Laurent Cave from EDEC. Laurent, please go ahead.
Okay. Yes. So actually, I had two quick questions as a follow-up to what Andrew said. I was wondering, because in Sweden, when we estimate the wealth distribution, so we actually observe the assets, and what we find is that bonds represent a very small share of net worth, right, for the wealthy. So indeed, it is a difference. My second question is, what we find in a paper that's forthcoming is that we find that the differences in returns, right, in discount rates are tied to differences in risk, right, taking in systematic risk. So I was thinking, since you're taking, differences in returns seriously, another aspect that you could study would be differences in like the distribution of risk taking, right, of systematic risk taking in the US, which I think would be very interesting. And we would be looking not only at the concentration of wealth, but also at the concentration of systematic risk, right?
Totally agree. I think focusing on the composition as like an interesting moment worth, further study, I think also then naturally feeds into a question of kind of risk, exposure, risk choice, and then the question of private business, which is typically undiversified versus,
yes,
public stock, which is very diversified. I think there's like some nice stuff there when you really, we're trying to move a bit beyond the here's what the top share is, and now we have nothing else to learn, to thinking about what is the nature of this wealth. So I totally agree with that point. I think it's a nice point.
Thank you.
Okay, great. So the next question is from Geoffrey Zheng at NYU Shanghai. Geoffrey, please go ahead.
Yep, thank you for the organizers, and really enjoyed the presentation today. I think my question was kind of addressed in the comments, but maybe I'd like to hear what both Eric and Emmanuel have to say about the extrapolation using Pareto tails of the Forbes 400, because just like the distribution of size for public firms today, we see that the really top firms have this very, very fat tail, but then that tail parameter will change as you sort of vary the cutoff for where you estimate this parameter. And so it seems like that would have implications for extrapolating from Forbes wealth to even things like the top 0.01%, certainly 0.1% and onwards. So yeah, I'd be curious to say, hear what you have to say. Thank you.
So I agree. I mean, we're not really using that very much in our paper. We're just using it to make a point about what the Forbes wealth is implying under these assumptions. But we are not trying to make a really significant contribution to the use of Pareto techniques in estimating the wealth distribution. I think like the issues of like what the Forbes wealth looks like at the top and whether the Pareto approximation is the right one to use It's a good question. I'm sure Emmanuel has more interesting things to say, so I'll change to him.
Yeah, my qualitative feeling is that Forbes does a good job for the decabillionaires, because almost all of them, will get, their wealth from big, very visible businesses, so they don't miss many of them. I think they are too thin in the, simple multi-billionaire range. They probably miss people, so that's why the Pareto distribution within the Forbes is probably not quite right in the way it varies. So that's my sense.
I see. But so you guys do sometimes use the Pareto thing to extend Forbes to the full billion, right?
We'd prefer now to do Forbes plus SCF. SCF has some billionaires, so that thickens a little bit the Forbes at the bottom.
So SCF suitably weighted above $1 billion.
Yeah.
Okay.
Okay, great. Sorry to intervene in the discussion. So the next question is from Luis Vichera at HBS. Luis, please go ahead.
Yeah, I just wanted to have a quick question on the capitalization of fixed income, which is what makes the big difference between the two papers. And Eric, you guys are using basically the promised yield on corporate debt. And there's a difference between promise and required or expected return. And if you were using something, I think standard finance would say to capitalize that income at expected or required return, not at the promised yield, which surely is going to give you a lower estimate. I think you're going to give you a bigger lower rate and therefore a bigger capitalization. Can you expand on that, on why you guys are designed to use promised yields and not some estimate of the expected or required return on the AAA bond or the corporate rates, please?
Yeah, for sure. I mean, why do we use the AAA at all as opposed to just using the SCF rate directly? And the answer to that is because you only have the SCF every 3 years, and we don't have it going back past 1989. And so we tried to find a proxy capital market yield that was available over a fairly long time period. We got the idea of using this corporate bond rate from research that folks at the Fed had done, where they had compared capitalization under AAA versus US Treasury 10-year, et cetera. So I think the idea of using that one is not to say that this is the asset that we think is like the median asset these people are holding, but that this is a rate of return that looks to line up with kind of the rates that we get when we compute using these data sources where we have both wealth and income flows. What assets do I think they actually are holding? Probably it's like a portfolio mix between, lower risk stuff, deposit-y stuff, some treasury stuff, and then some higher yielding stuff like investment grade or even, higher yield corporate bonds. If you look at the tax returns for political candidates who have released them, you have the tax returns and the wealth that they disclose. There are some that are very rich, like Carly Fiorina, Mitt Romney. The assets they're holding that generate taxable interest are kind of boutique-y assets like Goldman Sachs leveraged loan, mezzanine trust thing, and generates like $100,000 of fixed interest income. The interest rate on that, the promised rate, the expected rate is going to be above the AAA rate. So we think probably what's going on is there's some mix of those things that maybe this is a good proxy for. And then we use kind of mean squared error testing within the SCF to try and calibrate and see how our prediction error is for this model versus treasury versus equal returns. And that's why we settle on this. But I think your point about what are we using this for is a good question.
Okay, so thanks a lot for the great questions and for the great discussion and great talk. So there are more questions, but we're already out of time, although we extended it. So thanks so much, all of you, for participation. So the next week will be Dan Greenwald from MIT, discussed by Tony Whitehead. So we would be very glad if all of you can join us. So thanks, Eric, and thanks all of your co-authors, and thanks so much, Emmanuel, for the discussion.
you.
Thanks for organizing.